It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital, and joining me today, the Governor, the Mayor of Beckerville, USA, Mr. Michael Becker.
Hey, Paul.
Were you picked up in a car this morning that had a big state of Texas symbol on the outside of it?
Not today.
So typically when it comes around property tax time, they should be picking Michael up in a big limousine because he has to write one of the biggest checks in the state of Texas.
Yes.
To
supporting all the school just went back here locally, and we're supporting all the school children across the 6 or 7 counties we own in. So we're supporting children all over the Texas region.
Oh, you're happy to do it, I'm sure.
Yep.
So good for you. Michael, who has bought over 8,000 apartment units, now owns about 5,800 apartment units. So he's bought and sold a couple of them. $675 million in assets under management, purchased over $1 billion in apartments, $160 million worth of equity that he has raised with his company, SPI. So Michael has gone from being a loaner of money to an owner of real estate, worked for one of the largest banks in the United States, led his division for a number of years in commercial real estate lending, and then he's done a great job over at SPI. So we always enjoy speaking with Michael about what's going on and how to figure out if it's the right time to invest in real estate. So
Speaking of what's going on, Paul, what's going on in the old Capitol world before we get into today's question?
Oh, don't forget about October 24th, 25th at the House of Blues in Dallas, Texas. We have the Old Capital Multifamily Conference. Our keynote speaker this year, Coach Lou Holtz. Coach Lou Holtz really talking a little bit about doing the right thing and taking care of business. And so we want to have you come and network with probably less than 700-800 people at the House of Blues. We'd love to see you there. It is just not a regional conference. It is a national conference. So find a way to get into American Airlines, Delta, Southwest, come to Dallas, come see us and shake hands and meet other people in the multifamily industry, whether it's SEC attorneys or other brokers. Just listen to what they're saying. I think our panel that we're going to have, at least one of the panels, I think is great. We're going to have guys, we call this the rocking chair panel. We're having 5 guys that have been doing this for 35 to 40 years that have been buyers of real estate or managing properties. These guys have done it for a long period of time. So you want to listen to them, what they've talked about, how they've gone through different cycles, what's important not to get sued, what's important to keep your balance sheet straight personally. What happens if you have to ask for your partners with capital calls? What happens when the economy slows down and you can't get loans? These are the questions that people who have never done this before have to get those questions answered.
I think today's topic is very timely with that, what you just said. So I think, if nothing else, for you guys who have been in the business for the last couple of years, it's been a rising tide and all boats have been floating. But, at some point, trees don't grow to the sky. And at some point, there's going to be some level of a slowdown, a contraction. And depending on where you are in the country and what you're invested in, how you set it up, it'll be varying degrees of pain, so very little to a whole lot. So learning from guys that have been through multiple cycles. Most of these guys went through both the major depressions. We've had, the national one from 2008, about 10, 11 years ago, as well as the regional one with the S&L crisis of the late 80s, which is probably worse in a lot of ways than what was 2008 was, at least for the state of Texas. So learning from guys like that kind of successfully navigated through it and the lessons they learned, I think that'd be invaluable. So if nothing else, I'd buy a ticket, hop on a plane, come to Texas and learn from a bunch of seasoned apartment operators.
Go to the oldcapitalpodcast.com, oldcapitalpodcast.com, and an RSVP to come to Texas to see us. So talking about that, Michael, what is going on with these interest rates coming down, and should we have any concerns?
Well, as we record this a little bit less than a week ago, the primary yield curve has inverted. So what that basically means is for a while, go back to the end of 2018, the rates were rising. The Fed was increasing the overnight Fed funds rate. 10-year Treasury had broke over, I think it went to almost 3.2%, which, by historical levels is still pretty low, but it was up dramatically from earlier in 2018. Everyone thought rates were going to run away. And then ever since that happened, the entire year-to-date 2019 has been basically a steep decline of, well north of 100 basis points from kind of the peak. So, I think we're probably at this point, we're in the mid 150s on the 10-year Treasury. And I think it peaked at, 3.2. So it's, halved essentially from the peak about 9 months earlier. So what's happened is, the short-term rates are at a higher percentage of what the long-term rates are. And the main kind of two indexes everyone looks at is a 2-year treasury over the 10-year treasury. And last week, the spread inverted, meaning that the 2-year was at a higher rate than what the 10-year was. So basically what that means, or the economists forecast at the marketplace, that there's risk out there that people are willing to take a lower yield for a longer period of time because they're less sure about the future. So they're wanting to take the risk off their money. So they're willing to take a lower rate of return for a 10-year money than it is on 2-year money. I mean, we've seen the recently, about a month or so ago, they cut the primary rate at the end of July. The index of the overnights, the Fed cut by a quarter, and they meet again in September, and everyone's expecting probably at least a 50 basis point cut. So it looks like the short-term rates are shortly there to follow and start getting lowered. So, one of the things that having an inverted yield curve, the last 9 recessions, I think, have been preceded by an inverted yield curve. So usually somewhere around 18 to 24 months after the yield curve inverts that we're in a recession, or at least that's what the last, I think, 8 of the last 9 or some number like that have kind of predicted. So that's what everyone's starting to get a little bit nervous, I guess, Paul, kind of what's coming up. And so it's been a real interesting environment here. So we've been the beneficiary and the loser of this, on kind of depending on what side that you're on. So let's kind of talk about the bad first, that we had a deal cut. We decided to market a property towards the end of last year. So we decided, that's when kind of made the decision, and we decided to launch the property to market in January when, like, as I mentioned, the 10-year treasury was, 3% or maybe slightly above. And the entire time that we put a 12-year loan on it about 8.5 years ago. So we had a pretty large prepayment penalty back when the rates were in the kind of the high 4s, so like a 4.90 rate or something in that ballpark. Thinking that rates were going to go up a few years ago, and they never really did. And so then we have to deal with yield maintenance. So we were offering the property both as a loan assumption and as an all cash, where we just kind of suck it up so the buyer could pay a higher price, and then we suck it up and eat the prepay. But the net number would be comparable, right? So we go through the process, a little tougher marketing process, being that the property was like 37 million on a loan assumption, and pushing 40 million all cash. So as we talked about on recent podcasts, it kind of shrinks your buyer pool, because the biggest part of the buyer pool kind of is at 20 million and below number is really a lot larger than when you get over 20 million. But we fought through all that, got a good number, and it was going to be on a all cash basis. So we agreed to sell the deal in May. And our prepay on this particular deal was about $4.2 million. And as we, which it was up from about $3 million when we decided to list it, but the price we got was all good, and the math was going to work out, and we're going to net the same amount of money. Then as we were in escrow, just a slow motion death happened as I keep, every day the 10-year treasury kept going lower and lower and lower. And ultimately we started crying uncle in early July when it was prepay went up about $1 million. So we had buffered a few $100,000 in our price. And then the seller was going to pivot to do a loan assumption. And it turns out on the last podcast, as we mentioned, they weren't taking care of business with Fannie Mae on some existing loans. So Fannie Mae decided that they wouldn't allow them to actually come over and take over our loans unless they cleaned up some issues they had on their existing portfolio, which effectively was a death nail of the deal and killed it. But as we recorded, the prepay went from about 4.2 million, and it's about 6 million today. So we've been damaged almost $2 million in our prepayment costs. So we ultimately just kind of cried uncle and decided the deal just wasn't economically viable for us to sell. So that's been a pretty tough lesson to learn about some of these yield maintenance prepays, Paul.
Again, how does this yield maintenance stuff work? And if interest rates are falling, isn't that it's helping the buyer, but it's not helping you who currently had the loan? It's
a formula, basically. And it's really kind of two levers to it. One is what your note rate is relative to the current market interest rate. So basically, when the people buy these bonds, when you make a loan, Fannie Mae makes a loan, they'll sell the loan on the secondary market and they guarantee it. And this is what they call securitize it. So basically a bondholder will come buy it for an income stream, and they want to make sure they maintain a certain yield throughout the maturity of the loan. So they'll have these, yield maintenance that kind of match up for, the term of the loan or what's open 6 months prior to the maturity. So if you have like a 5% rate on your note, and the current market interest rates, so the rates have risen and the rates are like today, they can go about and you pay your loan off and they go replace replace it with 6% money, the prepayment penalty will be a little bit lower because they can earn more interest because the rates are higher relative to what the loan was that paid off. And the inverse is true, that if you have a 5% rate and the current rates in the marketplace are like 4%, they have to go buy more bonds to replicate that same income stream. So the prepayment penalty is going to be a little bit higher, so they can then kind of offset it. So that's how yield maintenance generally works. Same thing with defeasance. And then the other lever is how much time is to maturity. So if they have to go replace that income stream and you have a 12-year loan and they have 8.5 years, like in my scenario, they have more time than if it was like 4 years left. So they have to have more time to then replace it with a lower rate or the higher rate. So kind of the closer you are to maturity, the lower your prepay, the higher the current rates are relative to when you originated it, the lower the prepay. And then the inverse is true. The longer the maturity or the lower the rates are relative to your note rate kind of impacts your prepay up or down. So that's just something that, just got to make sure you pay attention. And these loans are assumable, so you can sell it. Someone can assume your mortgage. But if when we put the loan on, we got 3 years of interest only, which was great at the time. But now you get 5 years of interest only or 6 years of interest only. So a buyer will come in and kind of look at the debt constant or what their mortgage payment is going to be relative on an amortizing basis relative to what it would be on an interest only basis, and it kind of impacts their cash on cash and their economics as a buyer. So they would prefer to have it free and clear. But then if we have to weigh kind of what the purchase price, the higher purchase price they want to pay by putting new debt on it versus the cost of us to prepay our loan. And it's just math at the end of the day. And this scenario got all kind of screwed up, really. So that's just a real life lesson learned through yield maintenance and the impact of what's been happening in the treasury market. So
what did you do?
So we didn't sell it. So we told them that we're just not going to sell it. And I just think it would be silly for us to panic right now because we had a good quality asset and it's yielding basically double digits, and we're just going to get paid while we wait, and our loan's amortizing down, and we're just gonna wait for a better time. So that's the benefit of having longer maturity, and that's kind of what's happened. And then if the rates kind of come back up, and as we get closer to the end, we might kind of take a stab again in a couple of years and see what's going to happen in the marketplace. Until then, we'll just kind of pay out monthly distributions.
And so, with the inverted yield curve, you do probably see a recession coming down the pike, and so we've had a solid green light for the last couple of years. I think we're moving to a flashing yellow light. It's still green, but it's a flashing yellow light to a lot of the investors out there, a lot of the syndicators out there, that just, be careful, a little bit more careful out there on what you're doing. Interest rates go down, but they certainly can go back up.
Yeah, and so I think the other example that was recent that it was a positive for us is that we had a loan. We bought a property in July, and I think we were in escrow for like 90 days, but an extended escrow for the seller and the type of loan he had. I was almost 90-day escrow. So we had went in and got a Freddie Mac loan, and we ended up doing a floater. So we had a 10-year loan with 5-year IO, and it was a LIBOR plus spread floating rate loan. So to adjust every month the interest rate. And we took our recent lessons with the yield maintenance, and then the spreads were getting quoted back, we closed in July, so it would have been like sometime in April. So spreads we got quoted that, we're of a size that, always says unfair business. So the more business you do, the better spreads you get from your lender. And we had done a bunch of stuff with Fannie Mae, and Freddie Mac was coming at us pretty hard. So they ended up quoting us a 156 spread over 30-day LIBOR. So meaning whatever LIBOR is, 30-day LIBOR, on the first of the month, they'll whatever the 156 over 30-day LIBOR is what our note rate is going to be for that month. And there's no floor to it. So we ended up getting that kind of agreed upon. So they index locked it, and then ultimately we spread locked down the road, but they kind of held it. And, as I mentioned, they just recently cut the Fed funds rate, which directly impacts LIBOR, and it looks like they're going to cut it again. So if you go back to kind of a little history lesson during the recession for like 6 years, from basically 2009 to 2015, LIBOR is somewhere around a quarter point, pretty much steadily for about a 6-year period. So if LIBOR goes back to kind of where I think it's going to go, which I think is going to zero, but if it goes to zero, we'd basically pay a 1.56% pay rate on our loan. So we get the benefit of that. And then we realized the spreads are really good. We bought a deal a year earlier looking to refinance it. And about 3 weeks after, so sometime in May, we went to go try to quote a deal to refinance our loan, and we got quoted a 1.78 spread. So in about three weeks over LIBOR, 3 weeks, the spreads gapped up about 22 basis points for us, from 156 to 178. So initially we're a little upset about it, but we kind of just realized that that's kind of the way the winds are blowing right now, that as everyone's seeing the index dropping, in the future, spreads are going to gap up or rise, right? And so we just quickly got on top of that.
And again, spreads are what? What does that mean?
Yeah, so when you have this, whether you fix it or whether you float it, it's usually an index plus a spread. So if you fix it, it's usually the 10-year treasury plus a spread on top of it. And the day you index lock is a day that you fix it for the term of your loan. Or if it's floating, then your spread is whatever it is, and the index moves up and down. So you just pay your spread over the index. So we took that one out. Then 3 weeks later, we ended up doing a deal and taking it out at 22 bips higher, which then now we just recently quoted some deals about a week ago, and the spreads went up to about 220 over. So, so we're from almost 65 basis points higher. And then I heard this week they went up again another 10 or 15 bips. So I think these spreads are kind of on the street somewhere around 230 to 240 for us right now. So what's happening is a lot of upheaval, it seems like, at FHFA, which is the regulator for Fannie and Freddie. And Fannie and Freddie, I think, kind of as we talked about previously on the podcast, have lent so much money out there over their cap that they're kind of purposely slowing up some of the loan production. So how they're doing that is widening the spread. So as these rates are dropping, the spreads are gapping up. So the real rates that you pay aren't really following proportionately with the index, so the 10-year treasury plummeting or LIBOR plummeting. So the real rates are still kind of hovering, in that 4%
they're not
plus minus
just
range.
tapping the brakes. They're jamming their foot on the brakes to try to slow down the amount of new business coming in.
So it's just getting a little choppy out there right now. So just everyone kind of pay attention and, having a good quality team member like Paul or James or one of the old capital guys on your team to kind of help you navigate that and get you the best execution and, at least kind of give you a heads up of what's coming on. That's going to be more valuable than what I think the service a good, competent mortgage broker did a year or two ago, because a year or two ago, everything was easy. And now it's starting to become a little bit choppier. So make sure you have a good team member on your team and you understand what's going on, because it's getting a little choppy out there.
If somebody wanted to know a little bit more about what you do in your multifamily syndication business at SPI, tell them what's a good way of getting in contact with you.
Yeah, the best way really is to go to a company's website, which is my company's SPI Advisory. So just go to www.spiadvisory.com. That's SPI like spy. Advisory.com. There's a contact us form. Fill that out. I'm always happy to have a 10 to 15 minute telephone call with listeners of the podcast if they want to learn more about what we do. But just kind of finish my thought real before we wrap up is, that the 2 floating rate loans we got here is I'm pretty sure LIBOR is going to 0. We're going to have a sub 2% pay rate. So, we're going to be the beneficiaries of that. So why it sucked on the deal we ultimately couldn't sell. Hopefully, instead of making a 2x on our money in about 3.5 years, we'll make 3 to 4x of our money in 7 or 8 years just by being forced to own it a little bit longer. And even with the flashing yellow sign, like Paul said, all the markets aren't going to be created equal. And, I think there's a lot of money flowing out of the Northeast, which we should talk about a little bit here now with some of the stuff going on in the New York market. So that's all coming to the Southeast, Georgia, Florida, South Carolina. And we're seeing a lot of that more come to Texas. So I think every market's not created equal. So making sure you're doing the fundamentals of this business is even more important, because I've seen a lot of people out there that I guess I've been crying wolf for 3 or 4 years. I thought they're going to lose all their money by buying some tough properties at big prices, and they keep getting bailed out and rewarded. But I think at some point, trees don't grow to the sky, and the weaker properties and the weaker operators are going to be the first ones to get flushed out. So be careful.
Keep talking about that New York stuff. What do you mean by that?
Yeah, well, maybe we just got to have a whole nother podcast on that. I have a whole bunch of thoughts about rent control and some of the stuff that's going on, and the flight of capital out of the Northeast that's going to other parts of the country. Interesting.
Can't wait to talk to you about that. Okay. Again, if you wanted to get more information on Michael Becker's syndication business, again, what's that email address?
Go to our website, which is www.spiadvisory.com. Also, I think it's more important than ever to get educated and pay attention and stay on top of current market trends. So if you're still listening at this point of the podcast, I certainly congratulate you for listening through this long. Not to be self-serving, but I couldn't think of a better place for you guys to come out and listen to, a bunch of the brokers talk about real-time market, meet a bunch of other actual owner and operators. This isn't like a pretender type of conference. These are people actually out there doing deals, as well as listening to the old guys on the rocking chairs talking about the lessons learned and the tougher times and how they're in real time applying that to their business. And so if you get one little nugget that might save your ass one day, I think is definitely worth a couple $300 and getting on a plane and coming to Dallas and listening to them at the Old Capital Conference, which you can go to oldcapitalpodcast.com and buy your ticket. And the price is as cheap as going to be right now. It's only going to go up, and it's I can't imagine you don't get 100 times the value of that ticket if you come out and attend live.
Great information, Michael. Again, that was Michael Becker. I'm Paul Peebles. Have a great day.